Hey there, ready to unlock your financial future? We're diving deep into your sources today, tackling everything from early savings to smart investments, and even how to make frugal living work without feeling like you're missing out. Kind of like a financial boot camp, but way more fun.
And just like boot camp, the results can be life-changing.
Okay, so remember those cushy pensions our grandparents used to talk about? Well, the sources paint a pretty clear picture. Those days are fading fast. It's on us now to build our own financial security, and the best way to start, you guessed it, saving early.
Chapter 1 really drives this point home. It's not just about how much you save, but when you start.
Right, like even if you're just scraping by after graduation, stashing away a small amount consistently can make a huge difference down the line, especially because, as the source points out, you'll ideally increase those savings as your income grows.
Think of it like this. Let's say you're 22, and you put just $50 a month into an account with a decent interest rate. By the time you hit retirement, that small, consistent effort could literally turn into tens of thousands of dollars. That's the magic of compound interest at work.
See, that's what I love about this stuff. It feels way less intimidating when you break it down like that. But saving is just one piece of the puzzle, right? The sources also dive into different investment options, which, if I'm being honest, can feel a bit like a jungle out there.
Absolutely. But Chapter 2 acts as our trusty machete, cutting through the jargon to give us a clear path. We've got real estate bonds and securities and endowment policies, each offering a unique way to potentially grow your money.
Okay, so real estate first up. It's not just about buying a place to live, right? The source mentions something about leveraging.
Exactly. Think of it like this. Imagine you purchase a duplex. You live in one unit renting the other out.
Yeah.
That rental income can then cover a big chunk of your mortgage payments, essentially using someone else's money to build your wealth. That's leveraging in action.
Okay, that makes so much more sense now. So it's like a long-term strategy using property to generate income. Now, what about bonds and securities? Those always seem shrouded in mystery.
They might sound intimidating, but they're actually pretty straightforward. Imagine loaning money to the government or a company, and they promise to pay you back with interest. That's essentially what a bond is. You're lending money, and they're paying for the privilege of using it. The source specifically mentions government bonds as a generally lower risk option.
So kind of like a super secure IOU. And what about securities? Are those related to stocks?
Yep. You got it. Securities represent a piece of ownership in a publicly traded company. When you buy a company's stock, you're essentially buying a tiny slice of that company.
Ah, okay, that clicks. Now, endowment policies, those always sounded super official to me.
Think of them as long-term savings plans designed to build wealth gradually. You make regular contributions over time, and that money is invested with the goal of creating a nice nest egg down the line. It aligns with what we were saying earlier about the power of starting early and letting compound interest work its magic.
Right. So it seems like each of these investment types has its own personality and risk level. It's about finding what aligns with your goals, right? I'm curious which one piques your interest the most.
That's a tough one. I'm particularly fascinated by the potential of real estate to generate passive income through rentals. It's a strategy that combines long-term growth with more immediate cash flow.
Interesting. I can see why that would be appealing. Okay, so we've covered saving and explored different investment avenues. Now let's demystify a couple of terms that tend to make people's eyes glaze over. 401ks and IRAs.
Ah, yes, the retirement savings plans. They might seem like alphabet soup at first, but they're actually pretty straightforward once you understand the basics.
Okay, good, because the source dives right in, and I want to make sure we unpack this in a way that actually makes sense. So first up, 401k. It's something to do with your employer, right?
Exactly. It's a retirement savings plan that's often offered through your workplace. One of the biggest perks is that many employers offer what's called a matching contribution. Essentially, they'll put in a certain amount of money to match what you're saving.
Wait, so it's like free money, sign me up?
It's one of the best perks out there. And since the money is automatically deducted from your paycheck, it enforces a forced savings habit, even if you're tempted to spend it elsewhere.
Which, let's be honest, we all are sometimes. Now, IRAs, those are different, right?
Exactly. With individual retirement accounts, or IRAs, you're in the driver's seat. You set it up yourself, and there are two main types, traditional and Roth. The source gets into the specifics of each, but the main difference boils down to taxes.
Oh, taxes. Everyone's favorite topic. Hit me with the key differences.
With a traditional IRA, you often get a tax deduction when you contribute, but you'll pay taxes on the money when you withdraw it in retirement. A Roth IRA flips that script. You contribute after tax dollars, but your withdrawals in retirement are generally tax-free.
So it's about strategically choosing when you want to face those taxes. Makes sense. And of course, there's always the temptation to dip into those retirement funds early.
which the source strongly advises against. Those early withdrawals often come with hefty penalties eating into your hard-earned savings. It's crucial to treat those retirement accounts as long-term investments and resist the urge to raid them prematurely.
Got it. Keep those hands off the retirement cookie jar.
Mhm. So to sum it up with 401ks and IRAs, we're talking about tax-advantaged ways to save for retirement. Which one is right for you depends on your individual circumstances and how you want to handle those taxes. Exactly. And that's where doing your research or even consulting with a financial advisor can be incredibly valuable. They can help you navigate the nuances of each option and create a plan that aligns with your unique needs.
Speaking of creating a plan, this next chapter introduces another investment option, mutual funds. I've always found this concept kind of intriguing, but a bit fuzzy around the edges. Can you help me sharpen the focus?
Absolutely. Imagine a big basket filled with a bunch of different stocks and bonds. That's essentially what a mutual fund is. It allows you to invest in a diversified portfolio of assets without having to pick and choose individual stocks yourself.
So it's like outsourcing the stock picking to the pros.
Exactly. Mutual funds are managed by professional fund managers who do the research and make investment decisions on your behalf.
Sounds pretty hands-off. But the source also mentions some potential downsides, right? Like fees and market risk.
That's right. It's important to remember that mutual funds, like any investment, come with inherent risks. The market can be unpredictable, and even the most skilled fund managers can't guarantee returns. And yes, there are fees involved, so you'll want to factor those into your overall investment strategy. The key is to do your homework, understand a fund's investment strategy, and choose one that aligns with your risk tolerance and long-term goals.
Okay, so we've covered the basics of saving and dipping our toes into the world of investments. But let's get real. You need actual money to save and invest, right? Which brings us to a topic that might not sound as glamorous, but is equally important: frugal living.
Chapter 5 is all about making the most of what you have. And no, it doesn't mean living on ramen noodles and giving up all life's little joys.
Thank goodness, because my ramen eating days are long gone. What I appreciate about this source is how it reframes frugal as being intentional with your spending rather than just being cheap.
Exactly. It's about understanding your priorities, finding ways to cut back on expenses that don't align with those priorities, and then redirecting those funds towards things that truly matter to you.
Okay, that makes sense. So it's less about deprivation and more about making conscious choices. Got any specific examples from the source that come to mind?
Absolutely. One that resonated with me was the idea of downsizing without sacrificing your lifestyle. For example, maybe you've been eyeing that gas-guzzling SUV, but a more fuel-efficient car would actually better suit your daily needs and save you a ton on gas money in the long run.
Yeah. Right. Or maybe it's realizing you don't need to live in that trendy, expensive neighborhood when a smaller, cozier place in a quieter part of town would bring you more peace of mind and keep more money in your pocket. It's about aligning your lifestyle choices with your financial goals.
Precisely. And what about food? That's another area where small changes can make a big difference. The source talks about the benefits of cooking at home more often, and they're not just talking about saving money.
Okay, so spill the beans. What else is there besides saving money? I'll admit I sometimes fall into the takeout trap when life gets busy.
I hear you. But imagine this. You plan your meals for the week, hit the grocery store with a list, and spend a few hours on a Sunday prepping some healthy, delicious meals. You'll save money, eat healthier, and maybe even discover a hidden talent for cooking. It becomes less about deprivation and more about taking control of your health and your finances.
See, now you're speaking my language. You've inspired me to up my meal prep game. Okay, so we've covered downsizing and food. What about the elephant in the room, the one expense that keeps many people up at night? Housing. The source touches on the whole rent versus own debate, right?
It does, and it challenges the assumption that owning a home is always the ultimate financial goal. It highlights those often hidden costs of homeownership like property taxes, maintenance, and those unexpected repairs that always seem to pop up at the worst possible time.
Right, because sometimes those hidden costs can feel like a bottomless pit.
Exactly. So while owning a home can be a good investment for some, it's not necessarily the right path for everyone. Renting might offer more flexibility and fewer financial surprises, at least in the short term. This source encourages you to really crunch the numbers, consider your lifestyle, and decide what aligns best with your financial goals.
Makes sense. It's about making informed decisions, not just following the crowd. Okay, so we've tackled some major expenses, but now I'm curious about a topic that tends to cause some confusion: debt. This next source is all about the dreaded D word, and it specifically talks about the debt snowball method.
Ah, yes, a classic strategy for tackling debt, and it's particularly effective for those who feel overwhelmed by multiple debts. It's all about creating a sense of momentum and motivation.
Okay, because feeling overwhelmed is an understatement when it comes to debt. Break it down for me. How does the snowball work?
Imagine this. You list out all your debts, not by the amount owed, but from smallest to largest. Then you focus all your extra energy on aggressively paying down that smallest debt first while making minimum payments on everything else.
Okay, so you're kind of ignoring those bigger debts for now. That feels a little counterintuitive.
It might feel that way,
Yeah.
but the psychological boost of knocking out that first debt is huge. It's like boom, victory. That momentum gives you the fuel to keep going, tackling the next smallest debt and the next until you've cleared them all.
Okay, I can see how that psychological aspect would be super motivating. It's like you see actual progress, which makes the whole thing feel less daunting.
Exactly. It's a simple strategy, but incredibly effective. And as you pay off each debt, you free up more cash flow to put towards the next one, so that snowball really starts to roll.
Love it. It's like a financial snowball of awesomeness crushing debt in its path.
Exactly. Now, on a different note, let's talk about something called index fund investing. Have you heard of this approach?
I have, but honestly, the world of investing can feel like a whole other language sometimes. Demystify it for me. What are index funds and why should we care?
Imagine a giant basket of stocks representing a specific part of the stock market like the S&P 500.
Hmm.
An index fund is basically like buying a share of that entire basket. So instead of trying to pick individual stocks, which can be risky and time-consuming.
Like trying to find a needle in a haystack.
Exactly. With index funds, you're betting on the overall performance of the market, which, historically speaking, tends to go up over the long term.
So it's about diversification, spreading your risk across hundreds of companies at once, and riding the general upward trend of the market.
You got it. It's a long-term strategy, not a get-rich-quick scheme. But the beauty is, index funds are generally low-cost and relatively hands-off, making them a popular choice for both new and seasoned investors.
Okay, so index funds. Diversification, historical market trends, low cost, and relatively hands-off. Sounds promising. But are there any potential downsides we should be aware of?
Well, as with any investment, there's always some level of risk. If the market takes a dip, so will your index fund. You won't see those massive gains that come with picking individual winning stocks.
So it's a trade-off, potentially lower returns for lower risk and less hands-on management.
Exactly. It's about finding the right balance for your risk tolerance and investment goals. But speaking of taking action, this next source talks about a skill that can pay dividends in all areas of life, not just finance. Negotiation.
Okay, negotiation. That word always makes me think of high-stakes business deals or hostage situations, which luckily aren't things I encounter on a daily basis.
Right. But this source breaks it down in a way that's super relatable and empowering. It's not about being pushy or aggressive. It's about advocating for yourself and finding mutually beneficial solutions. And the best part, you can negotiate in countless areas of life.
Give me some examples. What are we talking about negotiating here?
Think about your salary. That's a prime example. Many people shy away from negotiating their starting salary, but even a small increase can make a huge difference over time, especially as raises are often based on a percentage of your current pay.
Right, because each subsequent raise is building upon that initial negotiated number. So advocating for yourself early on can have a ripple effect for years to come.
Exactly.
Yeah.
And it's not just about your salary. You can negotiate your rent, your cable bill, even the price of that vintage record player you've been eyeing. The key is to go in prepared. Be confident. And don't be afraid to ask for what you want.
That's great advice. I think a lot of people, myself included, underestimate the power of simply asking for what they want or what they deserve. We often assume things are non-negotiable when in reality they might be more flexible than we think.
Precisely. It's about shifting your mindset from, I have to accept whatever they offer, to, I have value to bring and I'm willing to advocate for myself.
Okay, so we've talked about slaying debt, exploring index funds as a potential investment strategy, and embracing the power of negotiation. Now, this next source feels like it ties it all together. It's all about building a personalized financial plan.
Ah, yes. This is where the rubber really meets the road. It's about taking all these individual pieces, all these financial concepts we've been discussing, and weaving them into a cohesive plan that aligns with your unique goals and values.
It's like we've gathered all the best ingredients, and now it's time to bake that financial freedom cake.
I love that analogy. And just like a good cake, a solid financial plan has a few key ingredients. This source emphasizes the importance of starting with your why, your financial goals. What are you ultimately working towards?
Right, because without a clear destination in mind, it's easy to wander aimlessly in the financial wilderness. But goals can feel kind of abstract, right? Like, how do you actually turn those aspirations into actionable steps?
That's where budgeting comes in. And no, it doesn't have to be a soul-sucking spreadsheet. The key is to find a system that works for you, whether it's an app, a notebook, or good old-fashioned envelopes. The goal is to understand where your money is going, so you can make conscious choices about how you want to direct it.
Right, because awareness is key. You can't fix what you don't acknowledge, right?
Precisely. Once you have a handle on your spending habits, you can start to identify areas where you can potentially cut back and redirect those funds toward your goals. Remember that conversation about downsizing and cooking at home? It all ties into this bigger picture of budgeting and aligning your spending with your priorities.
It's all connected. Okay, so we got goals, we've got budgeting. What else does the source highlight as essential for a solid financial plan?
It stresses the importance of building an emergency fund, a financial safety net for life's unexpected curveballs.
Okay, because those curveballs can really throw you off track if you're not prepared. How much should someone aim to have in their emergency fund?
That's a great question. It can vary depending on your individual circumstances and risk tolerance. Some experts recommend having 3-6 months worth of living expenses saved up, while others suggest aiming for even more. The key is to have enough to cover unexpected expenses, like car repairs, medical bills, or even a sudden job loss, without having to rely on credit cards or high-interest loans.
Right, because those high interest charges can really make a bad situation even worse. It's like you're already dealing with a flat tire and then you get hit with a hefty credit card bill on top of it.
Exactly. Having that emergency fund gives you peace of mind and financial stability. It allows you to weather those storms without derailing your long-term financial goals.
Okay, so we've covered goals, budgeting, and emergency funds. What about the I word, investing? How does that fit into this personalized plan?
This source suggests viewing your investment strategy as another key ingredient in your financial cake. And just like choosing the right type of flour or sugar, selecting the right investment approach depends on your individual taste, or in this case, your risk tolerance, time horizon, and financial goals.
Right, because what works for a seasoned investor in their 50s might not be suitable for someone just starting out in their 20s.
Exactly.
Yeah.
We've talked about index funds, and those can be a great option for those seeking a diversified hands-off approach. Bonds can also play a role, offering a bit more stability than stocks. And of course, there's real estate, which we've discussed as a potential avenue for building long-term wealth. It's about crafting a mix that aligns with your unique circumstances and aspirations.
So it's like building a custom-designed investment portfolio tailored to your specific needs and goals. Love it. But it's not a set it and forget it kind of thing, right?
Absolutely not. The source emphasizes the importance of regularly reviewing and adjusting your plan as life throws you curveballs. You might experience a career change, a growing family, or even a sudden windfall, all of which could warrant adjustments to your financial strategy.
It's like a living, breathing document that evolves with you. I love that.
Exactly. It's not about creating a rigid set of rules, but rather a flexible framework that empowers you to make informed financial decisions at every stage of life.
Okay, so to recap, building a personalized financial plan is about defining your goals, creating a budget, establishing an emergency fund, developing an investment strategy, and regularly reviewing and adjusting as needed.
You've got it. It's about taking control of your financial future one step at a time.
Beautifully said. We've covered a lot of ground here today, from the nitty-gritty of saving and budgeting to the excitement of exploring different investment options. But there's one final source I'm eager to delve into, and it's all about a topic that's often overlooked: the psychology of money.
Ah, yes. This is where things get really interesting. It's one thing to understand the mechanics of money, the how-tos of saving and investing. But it's another thing entirely to understand the emotions, beliefs, and even subconscious scripts that influence our financial decisions.
Right, because sometimes it feels like we're working against our own brains when it comes to money. Like, we know we should be saving more or investing wisely, but then those impulsive spending urges kick in.
Exactly. And this source dives deep into those underlying factors that shape our relationship with money, starting with our upbringing. The way our parents or caregivers talked about and managed money can have a profound impact on our own financial habits, even if we don't realize it.
Okay, that makes a lot of sense. Like, if you grew up in a household where money was constantly a source of stress or arguments, you might develop a scarcity mindset, always worrying about not having enough.
Precisely. And that scarcity mindset can then lead to a whole host of financial challenges, from overspending to hoarding money out of fear.
On the flip side, if you grew up in a family that had a healthier relationship with money, you might be more inclined to view it as a tool for growth opportunity and even generosity.
Absolutely. And it's not just about our upbringing. Our personal beliefs, values, and even past experiences can all play a role in shaping our financial behaviors.
So if our money mindset is so deeply ingrained, how do we even begin to identify and potentially shift those limiting beliefs?
That's the million-dollar question, isn't it?
Well, hopefully not literally $1 million, but you get the point.
Indeed. This source suggests starting with self-awareness. Pay attention to your thoughts and feelings around money. Are there any recurring patterns or beliefs that might be holding you back?
It's like becoming a detective of your own financial habits, looking for clues in those seemingly insignificant thoughts and behaviors.
Exactly. For example, do you find yourself constantly comparing your financial situation to others, leading to feelings of inadequacy or envy?
Oh, guilty as charged. Social media doesn't exactly help with that one.
Right. It's easy to fall into that comparison trap, but it's rarely productive or helpful. The key is to focus on your own financial journey, celebrate your progress, and seek inspiration from others without falling into the comparison game.
Okay, so awareness is key. But once you've identified those limiting beliefs or patterns, what's the next step?
The source suggests challenging and reframing those beliefs. For example, if you constantly tell yourself, "I'm bad with money," try to reframe that belief as, "I'm learning to manage my money more effectively."
It's about shifting from a fixed mindset to a growth mindset when it comes to your finances.
Exactly. And don't be afraid to seek support if needed. A financial therapist or a trusted friend who's good with money can offer valuable insights and accountability.
Because sometimes we just need that outside perspective, right? Someone to help us see things more clearly and challenge those ingrained beliefs.
Absolutely.
Yeah.
And remember, it's a journey, not a race. There's no one-size-fits-all approach to financial well-being. The key is to find what works for you. Honor your unique circumstances and celebrate your progress along the way.
Okay, so we've talked about mastering the mechanics of money, but now it's clear that understanding the psychology of money is equally important. It's about acknowledging those deeply ingrained beliefs and habits, challenging them when necessary, and embracing a mindset of growth and abundance.
Beautifully put. It's about aligning your financial actions with your values and aspirations, creating a life of both financial well-being and personal fulfillment.
I love that. It's not just about the numbers. It's about creating a life you love, a life that's both financially secure and personally meaningful. And that brings us to our final source, which focuses on a topic near and dear to my heart: giving back.
Philanthropy.
Yeah.
It's often seen as something reserved for the ultra-wealthy, but this source challenges that notion beautifully.
Yeah.
It emphasizes that giving back isn't just about how much money you have, but about aligning your financial resources with your values and making a positive impact on the world, however big or small.
Exactly. And I love how the source breaks down the different ways to give back beyond just writing a check to your favorite charity, which is fantastic, but there are so many other ways to make a difference.
Absolutely. It highlights the power of volunteering your time or skills to organizations that resonate with you. Whether you're passionate about supporting the arts, protecting the environment, or advocating for social justice, there's a cause out there that needs your unique talents and energy.
And what's amazing is that volunteering often benefits the giver just as much as the receiver. It's an opportunity to connect with your communities, make new friends, and gain a sense of purpose and fulfillment.
Precisely. It's a win-win situation. And it doesn't have to be a huge time commitment either. Even an hour or two a week can make a difference.
Okay, so we've talked about the power of volunteering, but what about those who might be in a position to make financial contributions?
This source encourages us to think of charitable giving as an investment, just like any other investment we've discussed. It's about incorporating it into your budget, even if it's just a small amount each month.
So it's not about waiting until the end of the year to make a one-time donation, but rather integrating giving back into your regular financial routine.
Exactly. And by choosing to support organizations that align with your values, you're essentially investing in the kind of world you want to live in.
I love that perspective. It's like you're not just donating money, you're actively shaping the future you want to see.
Precisely. And that's incredibly empowering.
Okay, so we've covered a lot of ground here, from the nitty-gritty of budgeting and saving to the more nuanced aspects of investing, managing debt, and even understanding the psychology behind our money habits. And we wrapped it up with the importance of giving back.
It's been quite the journey, hasn't it? And through it all, we've been guided by the wisdom and insights from your carefully curated sources.
Which is what makes this deep dive approach so unique and valuable. It's not just about generic financial advice. It's about tailoring those concepts to your specific interests and goals.
Exactly. It's about empowering you to become the CEO of your own financial life, making informed decisions that align with your values and lead to greater financial well-being.
Well said. Now, before we wrap things up, there's one last batch of sources we need to explore. These final few nuggets of wisdom promise to provide even more insights and actionable strategies for navigating the exciting world of personal finance.
Sounds intriguing. I'm eager to uncover these final gems and see what valuable lessons they hold.
All right, we're back, ready to unearth those final golden nuggets of financial wisdom from your sources. It's like we've been on this incredible treasure hunt, and now we're reaching the heart of the matter.
I love that analogy. And just like any good treasure hunt, there are bound to be a few surprises along the way. So what hidden gems are we uncovering in this last stretch?
Well, this first source really caught my eye because it tackles a topic that can feel a bit like navigating a financial earthquake, investing in a volatile market. We've talked about the importance of investing, but how do you actually stomach those ups and downs, those market swings that can leave even the most seasoned investors reaching for the antacids?
It's a question many people grapple with, and this source offers some much-needed reassurance. It emphasizes that market volatility is a natural part of the investing cycle. It's like the tide ebbing and flowing. The key is to avoid making rash decisions based on fear or panic.
Easier said than done, right? Especially when you see your hard-earned money seemingly disappear overnight.
Absolutely. But that's where having a solid investment strategy and a long-term perspective becomes crucial. This source reminds us that successful investing is not about timing the market perfectly, but rather about time in the market. The longer you stay invested, the more opportunity you have to ride out those short-term fluctuations and benefit from the overall upward trajectory of the market.
So it's less about trying to be the next Warren Buffett predicting every market move and more about staying the course, trusting the process even when things get a little bumpy.
Precisely. And remember that concept of diversification we talked about. That's your best defense against volatility. By spreading your investments across different asset classes like stocks, bonds, and real estate, you're less exposed to risk in any one area.
Right, so if one part of your portfolio is having a bad day, another part might be picking up the slack. It's like having a financial safety net.
Exactly. And if you're still feeling uncertain, remember that seeking guidance from a financial advisor is never a sign of weakness. They can help you create a personalized investment strategy that aligns with your risk tolerance and long-term goals, providing peace of mind during those turbulent market periods.
That's such a good point. Sometimes having that expert guidance can make all the difference, especially when it comes to something as important as your financial future. Speaking of making a difference, this next source really piqued my interest because it dives into a topic that's becoming increasingly important to investors: investing in a socially responsible way.
Ah, yes. Socially responsible investing, or SRI, is gaining significant traction as more and more individuals seek investments that not only generate financial returns, but also align with their values and contribute to a better world.
Exactly. People want to know that their money is working towards something positive, something bigger than just their own bottom line.
Precisely. And this source does a fantastic job of breaking down the different ways to engage in SRI. One approach is to invest in companies that have strong environmental, social, and governance (ESG) practices.
So we're talking about companies that are committed to sustainability, ethical labor practices, and transparent corporate governance.
Exactly. They're often referred to as impact investments because they're actively trying to make a positive impact on the world while still generating profits.
Okay, that makes sense. But it's not just about investing in good companies, right? Are there other ways to align your investments with your values?
Absolutely. This source also highlights the growing number of funds and investment vehicles that specifically focus on social or environmental causes. For example, you can find funds that invest in renewable energy, sustainable agriculture, or even affordable housing projects.
So it's like you can choose to put your money where your mouth is supporting causes you care about while potentially earning a return on your investment. That's amazing.
It really is. And as awareness of SRI continues to grow, we can expect even more innovative investment opportunities to emerge. It's an exciting time to be an investor who's passionate about making a difference.
I couldn't agree more. Now, this next source takes a bit of a personal turn. It's all about teaching kids about money, a topic that's close to my heart.
Ah, yes. Financial literacy for the next generation is one of the most valuable gifts we can give to young people, yet it's often overlooked in traditional education systems.
It's so true. We expect kids to magically figure out how to manage money when they become adults. But most of us never received any formal financial education growing up. It's like sending someone out into the world without teaching them how to read a map.
Precisely. This source emphasizes the importance of starting early, even with young children. It's about introducing basic financial concepts in age-appropriate ways, planting those seeds of financial literacy that can grow alongside them.
So we're not necessarily throwing them into the deep end of investing or anything, but maybe it's about giving them an allowance and teaching them how to budget that money, how to save for something they really want, and even how to donate a portion to a cause they care about.
Exactly, you hit the nail on the head. It's about empowering them with those foundational skills and helping them develop a healthy relationship with money from a young age.
And what's amazing is that these early lessons can have a ripple effect throughout their lives, influencing their financial decisions for years to come. But it's not just about what we teach them explicitly, right? This source also highlights the importance of leading by example.
Absolutely. Children are incredibly perceptive. They pick up on our habits, both good and bad, even when we don't realize it.
So if we're constantly stressed about money-making impulsive purchases or arguing about finances in front of them, those behaviors can become ingrained in their understanding of how money works.
Unfortunately, that's often the case. That's why it's crucial for us as adults to be mindful of our own financial habits and model the behaviors we want to see in our children.
It's like that old saying, do as I say, not as I do, just doesn't fly when it comes to financial education.
Exactly. We have a responsibility to be those positive financial role models, demonstrating responsible spending, saving, and even giving back.
Beautifully said. It's about breaking those negative cycles and creating a new legacy of financial well-being for future generations. And, as we approach the end of this incredible deep dive, I can't help but feel a sense of gratitude for the opportunity to explore these sources with you.
The feeling is mutual. It's been an absolute pleasure sharing this journey of financial discovery with you. We've covered so much ground, from the fundamentals of saving and budgeting to the nuances of investing, managing debt, navigating market volatility, and even understanding the psychology of money and the importance of giving back.
And we've done it all through the lens of your personal interests and goals, which is what makes this deep dive approach so unique and empowering.
Exactly. It's about taking those general financial concepts and making them relevant, relatable, and actionable for you.
And now, as we reach the end of this journey, I hope you feel equipped with the knowledge, tools, and inspiration to take control of your financial future and create a life of both financial well-being and personal fulfillment.
I have no doubt that you will. Remember, financial literacy is not a destination. It's a lifelong journey of learning, growing, and evolving.
Beautifully said. And on that note, it's time for us to sign off. But before we do, I want to thank you, our listener, for joining us on this incredible deep dive into the world of personal finance. Remember, knowledge is power, and you are now armed with the insights and strategies to make informed decisions that align with your values and lead to a brighter financial future.
Until next time, happy investing.